Welcome to the Treasury Update podcast presented by Strategic Treasurer, your source for interesting Treasury news, analysis, and insights in your car, at the gym, or wherever you decide to tune in. On this second episode of Diving into Data, Isaac Zaubi and Craig Jeffery of Strategic Treasurer examine an additional round of key findings uncovered through the company's 2018 industry surveys. Topics of discussion center on how corporate preferences and uses of mobile bank apps have shifted over time, what areas of compliance treasurers are most concerned about heading into 2019, and where elevated spend in financial technology is projected to occur over the course of the next year.
Hello and welcome to the second episode of the Treasury Update podcast as it concerns major survey learning points from 2018. This is Isaac Zaubi, and I'm joined, as I have been every single time I've been on this, by Craig Jeffery, managing partner here at Strategic. Craig, thank you for joining us.
It is excellent and good to be here with you, Isaac.
So the last time that we discussed these data points, we had just finished wrapping up some fraud experience, some items related to security spend, treasury fraud, which is very interesting. We are now completely shifting gears. To start off this discussion, we'll be focused on mobile banking applications, more specifically corporate usage of those applications over time. And this is something that as a millennial, I found particularly interesting and something that Craig has made fun of me for finding interesting. But the simple truth is that when mobile banking applications first came out, and we started monitoring this about 4 years ago, there was a lot of hesitancy and a lot of pessimism amongst corporates regarding their use. Much of that was for security reasons. And if you look at the data, 2017 saw that only 26% of corporates were comfortable with the use of mobile banking apps. 28% were uncomfortable. More were uncomfortable than comfortable. You fast forward to 2019, 36% are comfortable and 27% are uncomfortable. So we have crossed that tip of the iceberg, so to speak, in terms of who's comfortable versus who isn't. And that's interesting because in just a short amount of time, just 4 or 5 years since we've been monitoring this, we've seen that significant of a shift. What are your thoughts on that?
Well, I think the millennial jokes aside, it is interesting that it continues to grow. And it is expected that people would get more comfortable with mobile banking applications generally. But when we talk about for B2B payments, knowing what we know on the security side, that's a pretty big issue, right? I guess I wouldn't be quite so optimistic that I wouldn't say I've gotten comfortable or more comfortable or very comfortable on those from what we see, but people are more familiar with doing more transactions personally and seeing it there. And, still we're at a little over a quarter are uncomfortable or very uncomfortable with it. So there's definitely a shift and there's definitely a level of concerns. I think those concerns are healthy.
No, and that makes sense. And this is something we've covered, at multiple points. We've had multiple surveys that have uncovered sort of this unease regarding mobile usage, but also the growing levels of comfortability. And just looking again at specific areas where mobile applications are in play, going back to 2016, just over half of corporates were using mobile phones to even look at their emails, versus nowadays you see that at about a quarter of firms. Looking specifically at, transaction approval or transaction initiation. For transaction initiation, 12% in 2016 were able to do that via a mobile phone. Now it's about 18%. That's roughly a 50% increase relative in that 4-year time frame. And roughly the same amount for transaction approval, from 21% to 28% being able to do that in just a 4-year time frame. Maybe not as large of an increase as one would expect, but still fairly significant given just the few years there. And we've seen that across virtually all areas of mobile usage gradually increasing from year to year. And while that is expected, I think it's interesting to note because given the skepticism that we've seen at the same time, it does serve as a positive sign for the growing use of mobile banking and banks' efforts in that area.
Yeah, and this is where this survey data is so helpful in terms of seeing what the general thought is, not just our individual biases. So when I see things like email accessing increasing by almost 20% of the population growing, the ability to access those on mobile devices. Of course, that seems very logical. It fits with my thinking when I see it rise from receiving notification alerts. It's perfect. Your mobile device is with you. You get that management by exception. Someone's letting you know something's happened when you see it in some different areas. That makes perfect sense to me because it fits with what my thinking is, how I would answer those. Other ones where I see transaction initiation slowly creeping up, from 12% to about 18%. And then I think, okay, well, that is growing. If you're initiating a wire, for example, from a mobile device, that seems much riskier than, let's say, the transaction approval. Somebody has already done it. You're doing a secondary approval. That's sitting around 28% now. So it's higher. So we start calibrating some of these differences. That makes me feel more comfortable because I think more of the Treasury audience is thinking like I would think about those things. And it's, where is the biggest point of exposure? Well, initiating it, not necessarily approving it or getting information or viewing it.
Right. And it's clearly a calibrated approach to mobile device use, right? So yeah, uncovering the areas that are least risky, maybe increasing usage there first, and then over time, gradually opening up more functionalities as the software proves itself. Excellent. And while I did find that interesting, another area that I found particularly notable from the B2B payment survey that we ran with Bottom Line in 2018 focused around the use of card services, card payment, and how traction in card programs looks to be increasing dramatically, actually, year over year, just in a relatively short time frame. And the data that I have in front of me shows that in 2018, looking ahead to 2019, about 40% of firms were planning to spend more versus just 5% planning to spend less. So about 8 times more interest there, which is significant. And we've also seen, increase an interest for rebates over discounts, some other items that are kind of attached to that. So how do you see this coming into play, as we look out over the next 12 months? Do you see cards as being a significant item of interest for Treasury?
Well, I think that as we look at the survey data, it's very important for the number of firms. 9% plan to spend significantly more. In other words, increase their spending by more than 20%. Versus 31% for just more, and the increase of 5% to 20% in that range. So that 40%, that's a very significant number with some pretty healthy terms. I mean, almost 10% are planning on spending more than 20% over their prior year. That is a bit surprising to me, but when we think about that data in a macro level and against different company situations and organizations, I think there are more firms that are stratifying their vendor base. How are they going to pay them? Figuring out what's the optimal way of doing that. And card is a very good strategy, certainly for several sections of that stratification. As you look and you break it out, it's a very good fit for some of those. And so that's why I think we're seeing that, is because they're focused on areas as opposed to saying generically, what are we doing with the card? They're looking and focusing on that particular areas where it makes the most sense. Now, I think this is also happy news for two types of people. One is the banks that are offering these types of products. There should be pretty healthy growth when you got 40 plan to spend more, significantly more, and only 5% plan to spend less or significantly less. That's a pretty big gap. Third of your environment is increasing. So that's a good trend. Plus, there's people that aren't necessarily using programs. So very happy news for those who are trying to hit their goals on the bank side. On the organizations that are getting rebates, I think that's good news as well, because you're not alone. Other people are targeting this. They're getting specific and finding the most fertile grounds to use this by stratifying their vendor population opportunities to spend in this manner. And when you're leveraging a lot of spend and being able to get rebates on those, what might seem like a de minimis percentage becomes a huge amount when you're leveraging huge cash flow.
And one other a quick follow-up question as we look at this, 40% of firms planning to spend more here was surprising to me as well. And I know that, with the continual push for electronic payments that's been ongoing within the industry for a while now, particularly trying to eliminate checks maybe out of the payment systems or out of the payment workflows, do you think looking to adopt card payments versus checks or some other form of manual payment could be behind some of this? Or do you see that as sort of an ancillary concern?
Well, I would say it is both. I think it is behind some of it. Clearly moving from paper to other electronic methods like ACH or card, it's definitely behind part of that, because paper is terribly ineffective. It's very manual. I mean, sometimes card can be very manual, but it tends to be the most suboptimal way, as we've seen in some of our spend surveys. People say this is the worst to create payments and it's the worst to get, or it's one of the worst in both of those.
That is interesting and definitely something to look forward to in 2019 as the rest of our surveys run. Shifting gears entirely now, going from payment to compliance. We ran our compliance survey in the middle of 2018, and one of the interesting findings uncovered was that for both corporates and banks, KYC concerns posed the top challenges. One of the main issue that they were most concerned about. It's definitely caught me off guard. I was not expecting that, but I know you have some thoughts on the topic as well.
I have a range of thoughts and some are suitable to share. So, people complain about KYC. It's a real pain and people will make a lot of noise about it. So I'm not surprised that it's high on the list, that it's 64% have a very elevated concern is more than I might have guessed. I mean, I know the people that are impacted by it, it's a big pain. I guess I wasn't aware that it was, 2/3 of organizations are experiencing that. I would think that most organizations, so many organizations aren't growing and expanding that rapidly that the number would have to be lower. But no, this is impacting like everybody who's growing and expanding. And part of the feedback from this came from other results from the survey that 55% of firms suffered delays from operational activities, making a payment, setting up a vendor. The KYC stuff slowed things down, both from the corporate side, that's the number. There were similar big issues from the banking side. So that was clear number one. A bigger surprise to me was that FBAR was number 2 at 46% of firms. I mean, that's been out there for a while now that there's been some requirements, yet people are still having elevated concerns. It's tough to track. They're still doing it. It's a headache.
And what do you think is causing that? I know that we've seen, numerous delays on, the government side of things, putting off the reporting requirements year over year. And we've also seen some changes to how those submissions, the formatting submissions for FBAR, the requirements there have been shifting. So do you think it's just a matter of keeping up with the continuous change? Or do you think it's from the outset, this was a source of confusion and it's continued to be so?
Yeah, it is still fairly new. It's less than a decade old in terms of the individuals who have no financial interest having to report. And then some of the newer ones where they change the formatting requirement. Now you still have to use either a smart PDF or a completely new format, XML-based format from their 4 generations old reporting formats. That created a number of challenges for organizations. And I really think it's a pain, it's a headache, and people need to take it off. I know that's why we have that as part of a headache removal part of our business, is because people hate it and you have to do that. Another one I found interesting too was GDPR. That was 31% found that, that was one of their top 3. 31% found it as one of their top 3. And that's so new, but I think when we take this next year, I expect it to go up. And the reason I expect it to go up is I think not everyone understands the impact of GDPR on Treasury, on payments, et cetera. If you're not in the EU area, if you're in the EU area, you're hearing about it, you're thinking about it, it's there. If you're sitting in Canada or the US, you're like, oh, that's far away. Maybe I don't understand it. Maybe I believe the connection to what we do is very tenuous at best. Maybe it's something I don't have to worry about. Maybe it's all about marketing or individuals, but there is a connection. And so I think when we get a little farther down, or if there's certain lawsuits or issues about protecting that confidential data, not just the right to be forgotten, but you're making payments, people are looking through the system. We're making a payment maybe to a U.S. citizen who's now in the EU, or they've moved or they've done whatever. It creates an issue. So it's an issue I expect to rise next year.
No, and the truth is, obviously, if you're doing business in Europe and you are, obtaining sensitive information from those areas, whether it be for clients, corporates, whatnot, you do set yourself up to a potential exposure there, especially as the regulation, opens itself up. And I don't have the exact data in front of me, but it is interesting because I know that, in our most recent compliance survey, it was about 1/3 of the population that indicated they had no idea how GDPR applied to Treasury. But it was still a concern because they didn't know how it applied to Treasury. So it's more of a concern of, what are we supposed to do, or how do we even protect against this? Because what's the applicability?
Yeah, that's funny. You don't know what you don't know. But if you know what you don't know, you need to close it by learning what that element is and what's the applicability. And, the concept of, well, we don't have any operations in Europe doesn't mean you still don't have to comply with GDPR, because you may have people you're paying that are EU citizens. You have confidential data from there. And, the issue of protecting data and different ways of managing that, there's different regimes for how that's handled, and they tend to increase. And we see that in U.S., different states. California has a law that's, we're passing through the process of becoming a law, future data that touches on similar concepts, and others are doing the same. So definitely there's an impact to Treasury. It's not massive as if you're a marketer or if you're based in Europe, but you still have to comply with a number of these rules and aspects of it.
No, and to your point, it will be interesting to see how concern or priority for GDPR increases. We're still very early on the outset of this regulation, but as more firms become aware and familiarize themselves with how it will impact them, it should be interesting to see how that data switches. Moving on to our final piece of discussion here as we take a look at not security spend in particular, but spend across sort of the entire treasury and financial realm as it pertains to technology. So we asked practitioners, again, as part of our cash forecasting survey, to indicate which areas they intended to make significant information technology investments in over the course of the next year. And the results were interesting because there was quite elevated spend across a number of areas, Craig.
Yeah, there were. So the top 4 or 5, Treasury at 38%. 38% of firms felt that they would spend significantly in the following year, significantly on the information tech.
And when you say Treasury, what do you think that encompasses? I know that this is sort of looking at a couple areas of the Treasury function, but we asked if they intend to spend significantly on Treasury here. That was by far and away the highest category of spend, or not by far and away, but was the highest. So what do you see Treasury per se encapsulating?
Well, I would say it would include bank-related systems. It would include treasury management systems, risk systems, trading platforms, things of that nature, things that weren't defined specifically in the other question. So we didn't say, do you plan on spending significantly on bank treasury technology or treasury management systems or trading platforms or treasury aggregators? We spoke about the general functions. So that's a general answer in terms of a category of treasury. And this is an area we've looked at for a number of years. And this is not the highest level, but it's still at a very elevated level, one of the top 3 years, about even with a couple years ago, not quite last year. But once you get over 25% of firms planning to spend significantly, that's a good sign for the industry. So treasury spend is very heavy. The next one is payments. Now, payments has jumped back up. It took a little hiatus there for a bit. It's back up there at 36%. There's all kinds of faster, better payments. 36% of firms plan to spend significantly on payments. And that could be treasury or AP or other payments.
Do you see that as, maybe like a particular system or functionality being implemented in the realm of payments? Do you see that as distributed across a number of areas? Or have you seen anything in the past year or so that you would think is the root cause for that jump?
Yeah, now we ask way too many questions in our surveys, according to some people. But if we said, why did you pick payments? Why did you pick treasury? I think that there would be answers of, one, we have to update our system to support some of the newer payment formats, the newer, faster payments, better payments. There'd be some elements there. We're replacing old systems. We're looking to build compliance or implement APIs, doing things that will make a difference over time, putting in a treasury aggregator or a payment hub. Those are the reasons I think people would spend significantly or answer that question that way.
That makes total sense. And now looking at the next category of elevated spend. So 38% were on treasury, 36% on payments, and now 33% for cash forecasting. So just about exactly 1/3 of firms planning to increase spend there. And I found this interesting because, as we touched on earlier in maybe part of a different podcast episode, we have about 40% of practitioners indicating that the importance of forecasting will increase internally at their firm. So this spend does match that to an extent, that the importance is increasing and now they're looking to spend there.
Yeah. So this question specifically asks about the IT investment piece. So when you parse it out, some are putting people and tech to play. Some are focusing on tech. Some are focusing on people. So I think this is showing commitment in a couple areas, right? We're going to focus on it and we're going to spend money on IT. Sometimes we're spending money on the people side, but 1/3 of organizations spending there is a significant issue. The next area is bank account management, which is 32%, just slightly behind cash forecasting. When you think about bank account management, what have we talked about just before? We talked about know your customer. We've talked about FBAR's big issues. Everyone thought they did great on managing bank accounts until FBAR came along. They realized how bad they do it and how unautomated it is and how out of date and how they find accounts. That's one of those cases where the regulations helped point out issues and people have worked to address it. And so they're spending money to put systems in place, particularly when you have over 100 accounts or 7 or more banks, to track those items, signers, services, the security you put in place there. Those are all good signs. So that's another piece there.
the final area of elevated spend, and we would classify elevated as, if over 25% of practitioners are intending to spend significantly there, that is elevated spend. And for cash reporting, 26% of practitioners indicated an elevated intent. So what do you see sort of driving that?
Well, I think that's that full decade of people trying to increase the visibility to their accounts, their transactions everywhere. That global visibility is crucial. I'm going to diverge from that then and look at those 5 areas that we have that elevated spend. I know as you look below, you see reconciliation, financial risk management, all sitting right around 20%. Significant item. That's still important. 1 in 5 are planning to spend significant in those areas. Good if you're in that business. But let's focus on those top 5. When we think treasury, payments, cash forecasting, bank account management, and cash reporting, that's extraordinarily good news for treasury management system vendors, treasury risk management system vendors. Those are functions that are built into them to more or less of an extent. Maybe not all of them are payment featured functions, but they are doing bank account management now. They're focused on cash forecasting, treasury, and some other functions. So when we say a treasury management system vendor, TMS, TRMS, that sector, that space looks to have a very good run for 5 or more years. We see that supported by a number of data points, right? Including this spend, including areas of focus, including what's driving the organizations, where technology is coming in. That's a very key point.
That is a significant piece. And I will say that, in past surveys, we have obtained data that shows, payments and cash management functions are the core features that practitioners require when it comes to treasury technology. That's been shown time and time again. Cash forecasting and cash reporting at the very top. Cash management features are needed, and right after that is payments. So even though we do see a little bit of more elevated spend on payments, it is interesting, but it also, backs up the past data that we've seen that those areas are the most in-demand features and are continuing to be so, which, to your point, does post well for most TMS vendors because those are pivotal components of those technology solutions.
Yeah, let me talk about 2 other non-corporate recipients of this largesse that's coming by. So when we think about banks are providing a number of services. Where are they focused? Treasury, certainly. They're offering many types of online portal type functions, other services that are integrated. Payments, certainly. Treasury and payments, some banks name their whole group cash management and payments or things along those lines. So they're focused on these payments because that's a huge part of the operational support that they provide to their clients. Cash forecasting, not as much. Bank account management in terms of supporting, know your customer, helping that process go smoothly. A number of banks are working to make that easier for their clients. They realize that it's a point of pain. So they're focused on that. And cash reporting, the information reporting side of the bank, providing data in the format and the frequency that people want is exactly up a bank's alley. They know how important it is to their clients. They make good margin on the data, and they want to provide as much as they can because they know it fits into the processes of the company. So this planned spend is very good news for banks as well for multiple years. And then finally, I want to talk about payment hubs and treasury aggregators. That there's some good news here too. So when you think about payments, that's Treasury Hub or Treasury Aggregator supporting payment formats all across the board, and cash reporting, that inbound information side. So 2 huge areas of what they provide are areas of significant spend. Big issues to be solved. People are focused on it, want to spend money, and those vendors should have a very good run, at least 3 years, 3 or more years of elevated spend in those areas as well. So you can see the growth of capabilities on treasury management systems to do that. You can see the full range of offerings by banks, and you see the treasury aggregators and payment hubs adding functionality here too, going after solving those needs and money and attention following that.
So all good news for treasury technology providers, especially in those areas of elevated spend. Thank you, Craig. That is actually the last data point we had to cover. I appreciate you taking the time out of your busy and hectic day to talk with me. I look forward to collaborating on more moving forward.
All right. Thanks, Isaac.
You've reached the end of another episode of the Treasury Update podcast. Be sure to follow Strategic Treasurer on LinkedIn. Just search for Strategic Treasurer. This podcast is provided for informational purposes only, and statements made by Strategic Treasurer LLC on this podcast are not intended as legal, business, consulting, or tax advice. For more information, visit and bookmark strategictreasurer.com.